What if I told you that the biggest reason most traders lose money has nothing to do with indicators, chart patterns, or finding the perfect strategy? Imagine two traders looking at the exact same chart. They have the same information, the same trading platform, and even the same market conditions. Yet one walks away with consistent profits while the other blows up their account. How is that possible? The answer isn't hidden inside a secret indicator or an expensive trading course. It's hidden inside the human mind. Every time you buy or sell, you're not only trading against millions of other participants, you're trading against your own emotions. Fear whispers that you should exit too early. Greed convinces you to hold for just a little more. Hope makes you believe a losing trade will magically recover. Ego refuses to admit a mistake. The market doesn't know your name, doesn't care about your opinion, and never rewards wishful thinking. It only rewards discipline, patience, and sound decision-making. The traders who survive for decades are not the smartest people in the room. They are the ones who master themselves before trying to master the market. Throughout this journey, we'll uncover the timeless principles that separate professionals from amateurs, explain why most traders repeatedly make the same costly mistakes, and reveal how successful traders think long before they ever place a trade. Stay with me until the very end, because by the time this journey is over, you'll no longer look at the stock market as a place to gamble. You'll begin to see it for what it truly is, a battlefield of psychology where the greatest advantage is not predicting the future, but controlling yourself. Every new trader enters the market believing that success comes from discovering the perfect strategy. They search endlessly for indicators with impossible accuracy, magical chart patterns, or someone who claims to know exactly where prices will move next. They jump from one method to another, convinced that the next system will finally unlock consistent profits. Months pass, sometimes years, and the cycle continues. Yet experienced traders eventually discover a surprising truth. No strategy wins every trade. No indicator predicts every move. No market expert is correct all the time. The search for perfection is not only impossible, it is often the very reason traders fail. Success in the market begins the moment you stop asking, "How can I avoid every loss?" and start asking, "How can I manage losses while allowing winners to grow?" The market itself is a reflection of human behavior. Every candle on a chart represents thousands or even millions of individual decisions made by people reacting to hope, fear, confidence, uncertainty, excitement, and panic. Prices rise because buyers become more aggressive than sellers. Prices fall because sellers become more determined than buyers. Behind every chart lies human psychology unfolding in real time. This is why markets often appear irrational in the short term. News, rumors, emotions, and expectations constantly influence prices. But over longer periods, discipline consistently outperforms emotion. One of the first lessons every successful trader learns is that protecting capital comes before making profits. Imagine a professional boxer entering a championship fight. Winning requires landing powerful punches, but surviving requires protecting yourself from being knocked out. Trading works exactly the same way. If one reckless decision destroys your trading account, it doesn't matter how good your next trade might have been. The first responsibility of every trader is survival. Capital is opportunity. Lose it carelessly, and you remove yourself from the game entirely. This is why risk management stands at the center of professional trading. Before experienced traders think about how much they could make, they first determine how much they are willing to lose if the market proves them wrong. That simple shift in thinking changes everything. Instead of hoping, they prepare. Instead of gambling, they calculate. Every trade begins with an exit plan before the entry is ever placed. This may seem cautious, But it is precisely this discipline that allows professionals to remain in the market that year after year, while countless others disappear after a handful of emotional decisions. Another important truth often surprises beginners. Being right is far less important than making money consistently. Many traders become emotionally attached to their opinions. They want the market to prove them correct. When prices move against them, they refuse to accept reality. Small losses become large losses because admitting a mistake feels painful. Professional traders think differently. They understand that the market owes them nothing. If new information invalidates their original idea, they exit without hesitation. Their goal is not to protect their ego. Their goal is to protect their capital. Ironically, accepting small losses quickly often becomes one of the biggest reasons they achieve long-term success. Patience is another quality that separates professionals from amateurs. Modern technology encourages constant action. Charts move every second. Financial news arrives every minute. Social media creates the illusion that successful traders are making money every single day. This environment tempts beginners to believe they must always be in a trade. But experienced traders understand that doing nothing is often the most profitable decision available. They wait for high-quality opportunities instead of forcing trades simply because the market is open. They know that one excellent trade can easily outperform 10 average ones. As we begin our journey through inside the mind of a successful trader, remember this simple truth. The greatest battle in trading is never fought on the chart. It is fought within your own mind. Master your emotions, respect risk, remain patient, and allow discipline to guide every decision. Because in the end, successful trading is not about predicting every market movement. It is about becoming the kind of person who can consistently make intelligent decisions regardless of what the market does next. One of the biggest misconceptions about trading is that the market is there to reward intelligence. It isn't. Every trading day, highly educated professionals, experienced investors, institutions, algorithms, and beginners all compete in the same marketplace. The market doesn't ask who has the highest degree, who has read the most books, or who has the most confidence. It responds only to supply and demand. That is why even brilliant people can lose money if they allow emotions to control their decisions, while someone with average knowledge but exceptional discipline can achieve remarkable consistency. Inside the mind of a successful trader begins with accepting a simple but powerful truth. The market is completely indifferent to your expectations. It will move according to the collective actions of millions of participants, not according to what you hope will happen. Every trade begins long before the buy or sell button is pressed. Professional traders spend far more time preparing than they do executing. Before entering the market, they know exactly what they are looking for. They understand the conditions that match their strategy, the level at which they will admit they are wrong, and the point where they will begin protecting profits. They remove as many decisions as possible before emotions have a chance to interfere. Beginners often do the opposite. They open a chart without a clear plan, react to every movement, and allow excitement to determine their actions. Preparation creates confidence. Improvisation creates stress. Imagine two pilots preparing for a flight. One carefully checks every system, reviews the weather, studies the route, and prepares for possible emergencies before leaving the runway. The other starts the engines and decides to figure everything out while already in the air. No passenger would willingly board the second aircraft. Yet this is exactly how many people approach trading. They risk real money without first defining their rules. The market quickly exposes this lack of preparation because uncertainty magnifies every emotional weakness. Another characteristic of successful traders is their relationship with uncertainty. Most people crave certainty before taking action. They want absolute confirmation that a trade will succeed. But certainty does not exist in financial markets. Every trade carries risk. Even the strongest setup can fail because unexpected events, changing sentiment, or large institutional orders can alter price direction within seconds. Professionals accept this uncertainty instead of fighting it. They understand that their goal is not to eliminate risk, but to manage it intelligently. They think in terms of probabilities rather than predictions. A strategy that succeeds 6 times out of 10 can still be extremely profitable if losses remain controlled and winning trades are allowed to develop. This shift from prediction to probability changes everything. Imagine flipping a weighted coin that lands on heads 60% of the time. No single flip is guaranteed. You may experience several losses in a row despite having a statistical advantage. But over hundreds of flips, the probabilities begin to reveal themselves. Trading operates in a similar way. One trade proves nothing. 10 trades reveal very little. But after following a disciplined process over hundreds of carefully executed trades, consistency begins to emerge. Successful traders measure their performance by the quality of their decisions, not by the outcome of any individual trade. One of the greatest enemies of consistency is overconfidence. After several profitable trades, many beginners begin believing they have mastered the market. Position sizes increase. Risk management becomes less important. Trades are taken more impulsively because recent success creates the illusion of invincibility. Ironically, this confidence often appears just before significant losses. Professional traders remain humble regardless of recent performance. They understand that every new trading day presents an entirely new set of probabilities. Yesterday's profits provide experience, not guarantees. The opposite emotional trap appears after losses. A losing streak causes many traders to question every decision they make. Some abandon perfectly sound strategies after only a few unsuccessful trades. Others attempt to recover losses immediately by increasing their position size, a dangerous behavior often called revenge trading. Instead of following their plan, they begin chasing the market with growing frustration. This emotional cycle frequently transforms manageable losses into devastating ones. Experienced traders recognize this danger early. After difficult periods, they often reduce position sizes, review their trading journals, and focus on rebuilding confidence through disciplined execution rather than emotional recovery. Keeping a trading journal may sound simple, but it is one of the most valuable habits a trader can develop. The journal records far more than entry and exit prices. It captures the reasoning behind every trade, the emotional state of the trader, market conditions, mistakes made, and lessons learned. Over time, patterns begin to appear. Perhaps profitable trades consistently occur during certain market conditions. Perhaps losses increase whenever impatience influences decision-making. These insights cannot be discovered through memory alone. The journal becomes a mirror, reflecting not only market behavior, but personal behavior as well. Perhaps the most profound lesson in trading is that success rarely comes from finding something no one else knows. More often, it comes from consistently applying principles that almost everyone already understands, but few people follow with unwavering discipline. Wait patiently for quality opportunities. Protect your capital. Accept losses without emotion. Let profitable trades develop according to your plan. Continue learning without becoming overconfident. These ideas sound almost ordinary, yet applying them consistently separates the small percentage of long-term winners from the vast majority who eventually leave the markets disappointed. As your journey through inside the mind of a successful trader continues, remember that every chart is ultimately a reflection of human behavior, and every trading decision is an opportunity to strengthen either discipline or emotion. The market will always present uncertainty. It will always test your patience, challenge your confidence, and tempt you to abandon your plan. Those tests never disappear. even for professionals. The difference is that successful traders no longer see those challenges as obstacles. They see them as part of the process, because in the end, mastering the market begins with mastering the person looking at the chart. The longer you spend in the market, the more you realize that charts are not simply collections of candles moving up and down. They are visual records of human emotion. Every green candle reflects moments when buyers became more confident than sellers. Every red candle tells the story of fear, uncertainty, or profit-taking. Support and resistance levels are not magical lines drawn on a screen. They are places where thousands of traders remember what happened before. A support level exists because buyers previously believed a price represented value. A resistance level forms because sellers once believed the price had become expensive. Markets have memory because people have memory, and that memory quietly shapes future decisions. One of the greatest advantages a trader can develop is learning to observe without immediately reacting. Imagine standing on the bank of a fast-moving river. You could jump into the current the moment you arrive, or you could spend time watching how the water flows, where the strongest currents are, and where hidden obstacles lie beneath the surface. The second approach may seem slower, but it dramatically increases the chances of crossing safely. The market rewards the same patience. Successful traders do not feel pressured to participate in every movement. They understand that the best opportunities often reveal themselves only after careful observation. Another important shift occurs when traders stop asking, "How much money can I make from this trade?" and begin asking, "Does this trade fit my plan?" Those two questions produce completely different behavior. The first is driven by emotion and excitement. The second is driven by discipline and consistency. Professionals know that profits are the result of following a process, not the objective of every individual trade. When the focus remains on execution rather than immediate financial reward, emotional pressure begins to disappear. Ironically, this often leads to better long-term performance. There is also tremendous value in understanding market context. A single candlestick pattern means very little when viewed in isolation. A breakout occurring during a strong uptrend carries a different meaning than the exact same breakout appearing after months of sideways movement. Likewise, a pullback inside a healthy trend is very different from the beginning of a complete trend reversal. Professional traders never judge one candle alone. They study the larger picture first. They ask what the market has been doing, what participants are likely expecting, and where significant buying or selling pressure may appear next. Many beginners become fascinated with predicting exact tops and bottoms. It is an understandable temptation. Catching an entire move from beginning to end seems like the ultimate achievement. But experienced traders know that consistently attempting to pick turning points often leads to frustration. Trends can continue much longer than expected, and reversals frequently occur without obvious warning. Rather than trying to capture every point of a move, professionals prefer taking the highest probability portion. They willingly leave some profit on the table if doing so improves consistency over hundreds of trades. They understand that surviving the market is more important than impressing others with a perfect entry. Risk management deserves constant attention because it quietly determines every trader's future. Imagine two traders, each with 100,000 rupees in their account. The first risks 2,000 rupees on every trade, regardless of confidence. The second risks 20,000 rupees whenever a trade feels certain. After a series of unexpected losses, the difference becomes dramatic. The first trader still has both capital and confidence to continue. The second now faces enormous psychological pressure simply to recover. Large losses create emotional decision-making, and emotional decision-making often creates even larger losses. Consistent position sizing is not exciting, but it is one of the strongest foundations of long-term success. Patience also extends beyond entering trades. Many traders find it surprisingly difficult to remain in profitable positions. The moment a trade moves into profit, fear begins whispering that the market might reverse. They close the position early, locking in a small gain, only to watch the trend continue exactly as their original analysis suggested. At the same time, those same traders often hesitate to close losing positions because they hope the market will recover. Successful traders gradually reverse this behavior. They cut losses according to their predefined rules while giving winning trades enough room to develop. This single adjustment can dramatically improve long-term results without changing the trading strategy itself. Another powerful habit shared by experienced traders is emotional detachment from individual outcomes. A profitable trade does not make them feel invincible, and a losing trade does not make them question their entire ability. They understand that every outcome is only one small sample within a much larger series. Their confidence comes from trusting their process rather than celebrating or fearing any single result. This mindset creates remarkable stability because it prevents emotions from swinging wildly with every market movement. Perhaps the greatest transformation occurs when trading evolves from excitement into routine. Beginners often seek constant action because action feels productive. Professionals understand that consistency comes from repetition, preparation, and discipline. Their daily routine may appear almost ordinary. They review markets, identify opportunities, wait patiently, execute according to plan, record the outcome, and prepare for the next session. There is very little drama because successful trading is not built on dramatic moments. It is built on ordinary actions performed extraordinarily well over many years. As we continue through Inside the Mind of a Successful Trader, remember that the market is not trying to defeat you, reward you, or teach you lessons personally. It simply reflects the collective decisions of millions of participants. Your greatest edge will never come from predicting every move correctly. It will come from developing the discipline to act consistently, the patience to wait for quality opportunities, and the humility to accept that uncertainty is a permanent part of every market. In the end, the trader who masters these qualities discovers something far more valuable than a profitable strategy. They develop a mindset capable of succeeding not only in trading, but in every area of life where discipline, patience, and clear thinking matter most.